Welcome to the Explainer. Today we're popping the hood on Realty Income, ticker symbol O, to figure out if their famous 5.2% dividend is actually safe in today's, well, kind of unpredictable economy. You know, a high dividend yield always grabs our attention, right? But it isn't automatically a slam dunk. So we're going past the flashy headlines. We're going to look at the hard numbers, the underlying cash flow, the balance sheet, and honestly the biggest risks you absolutely have to understand when you're sizing up one of America's most famous income stocks.
All right, let's kick things off by imagining an investment where you don't have to wait 3 long months for a payout. Instead, think about a payout schedule that lines up perfectly with your everyday life. Your mortgage, your utility bills, your grocery runs. That is the exact business model driving Realty Income. With the share price hovering in the low 60s, its annualized dividend of about $3.25 per share works out to roughly 27 cents per share, dropping into your account every single month.
And that consistency, it boils down to one absolutely staggering number, 674. That's the number of consecutive common stock monthly dividends declared by Realty Income as of August 18, 2026. I mean, just think about what that looks like in the real world. Month after month, year after year, for over half a century, they've completely owned this identity. They literally trademarked the phrase, the monthly dividend company. Through market crashes, the housing crisis, global pandemics, that monthly check just kept clearing.
But hey, it's not just about paying the dividend, is it? It's about growing it. They've handed out 135 dividend increases since hitting the New York Stock Exchange back in 1994. And get this, that run includes 115 consecutive quarterly increases. No wonder retirees and hardcore income investors completely flock to this stock. They aren't just buying a tiny slice of real estate, they're buying into a machine of predictable, recurring, and growing income designed to outpace inflation over the long haul.
So, the secret sauce here is understanding this brilliantly simple yet massive mechanism. Realty Income's entire playbook comes down to 5 basic steps: buy properties, lease them out, collect the rent, use that cash flow to support the dividend, and repeat. Sounds almost too easy, right? But the sheer scale they operate at is mind-blowing. They act as a mega-diversified landlord across a gigantic global real estate portfolio, spreading their bets far and wide instead of sweating over one specific property type or a single massive tenant.
Okay, but here's a massive trap that catches a lot of newer investors off guard. Because Realty Income is a real estate investment trust, or a REIT, we absolutely cannot judge it using standard net income, like we would for, say, a tech giant or a consumer brand. Doing that is a fast track to making terrible investment choices. While normal companies live and die by net income and earnings per share, a REIT operates differently. They make their money collecting rent, all while navigating these heavy, complex depreciation schedules on their buildings. So we've got to use a different measuring stick. We have to zero in on cash flow metrics like FFO and AFFO.
So, what on earth is AFFO? Adjusted Funds from Operations. It's basically the gold standard metric used to figure out the true recurring cash-generating power of a real estate portfolio. It strips away all the messy accounting noise, like non-cash depreciation, and just hands us the pure cash picture. We have to look closely at AFFO because it answers the million-dollar question for any dividend investor. Does the actual cash-generating business support that $3.25 annual payout?
Well, the answer to that question is a resounding yes. In the second quarter of 2026, Realty Income posted an AFFO per share of $1.09. That's a solid 3.8% jump year over year. So even while they're sending out those hefty monthly dividends to shareholders, this 3.8% growth tells us the underlying cash engine, the actual physical rent checks rolling in, is absolutely growing right alongside it. But wait a second. If the cash flow is growing and the dividend is basically bulletproof, we have to stop and ask a much tougher question. Why on earth does the market price this stock to yield over 5%? Now, a 5% yield looks gorgeous in your portfolio, for sure. But in the financial world, a super high yield is usually a flashing caution sign. The reason? It almost always boils down to investors demanding more compensation because they perceive a higher level of risk. And that brings us to what we like to call the Treasury problem. Notice that on August 17, 2026, the 30-year Treasury yield hit right around 5.31%. Meanwhile, Realty Income's forward yield was sitting slightly lower, at roughly 5.1 to 5.2%. Think about the reality of that for a second. The U.S. government was actually offering a higher yield with virtually none of the equity risk. When a risk-free government bond pays you more than a publicly traded stock, holding onto that stock suddenly starts feeling a whole lot less exciting.
Because when investors can grab 5.31% essentially risk-free, REIT shares face a ton of downward pressure. This perfectly explains why Realty Income stock took a nearly 4.88% hit in the previous month alone, even though those monthly rent checks kept arriving flawlessly. It's so important to remember this concept. A stock's price can drop while the actual dividend remains completely unchanged. The yield goes up simply because the share price went down. It's the market's way of saying, hey, if you want me to hold this instead of a safe government bond, you need to pay me more.
And look, the pressure isn't just coming from competing yields. It's bleeding right into their daily business operations. Real estate is intensely capital heavy. I mean, you aren't buying billions of dollars in commercial property by dipping into a checking account, right? It requires massive borrowing, using this carefully balanced tightrope of equity and debt. When interest rates are sky high, borrowing costs go through the roof and new acquisitions become drastically more expensive. For standard REITs, these tighter margins can basically strangle their expansion. It directly threatens their growth because it shrinks that critical gap between the yield they earn on a new property and what it costs them to borrow the money in the first place.
But Realty Income? They aren't just sitting on their hands hoping the macroeconomic weather changes. They recently put a massive $6 billion to work. Back in June 2026, they announced a huge programmatic joint venture, seeding it with initial assets valued at over $6 billion. They are literally flexing their biggest competitive advantage, their sheer massive scale and top-tier access to capital, to carve out totally new avenues for future growth.
So what exactly is that $6 billion buying? The AI real estate pivot. Honestly, this is genuinely fascinating. They're breaking out of their traditional retail shell and aggressively moving into hyperscale data centers. Think about it. Artificial intelligence models need massive computing power. That power demands colossal data centers, which require enormous physical infrastructure. Now, Realty Income isn't trying to be a tech company, not at all. But they are brilliantly positioning themselves to be the literal landlord to the digital infrastructure that's supporting the entire AI and cloud computing boom. All right, let's piece this whole puzzle together. Over on the bull side, you've got this pristine, almost legendary history of 674 consecutive monthly dividends. You've got a cash engine with AFFO growing at a super healthy 3.8% and a forward-looking $6 billion AI data center pivot that opens up huge potential. But flip it over to the bear side. You are staring down very real, very heavy macroeconomic headwinds. High interest rates are turning government bonds into serious competition. Borrowing costs are up. Tenants might struggle in a tight economy, and let's face it, past dividend growth never automatically guarantees future payouts. Because at the end of the day, you've absolutely got to remember the golden rule of income investing. Your total investment result equals your dividends plus the share price movement. Grabbing a 5% yield is totally meaningless if the underlying stock price completely tanks by 15%, right? You'd be down 10% before even factoring in your taxes. We aren't just hunting for the biggest, flashiest yield out there. We're hunting for sustainable, reliable income priced at a reasonable valuation.
Ultimately, here is the million-dollar question you need to be monitoring. Realty Income is built on a timeless, proven model: acquire assets, collect the rent. But as high interest rates fundamentally reshape the global real estate landscape, can a 50-year income machine really continue growing its dividend when the cost of money stays this high? Is that famous monthly dividend actually supported enough to withstand the real-world macroeconomic risks looming on the horizon? That is the exact question every focused investor needs to answer for themselves before chasing that 5.2% yield. Thanks for joining me on this explainer, and remember, keep asking the tough questions.